more importantly, a look ahead into 2026 with Matt Kettner over at HSBC writing the big concern with regards to that big AI trade is when CapEx starts to drop. Worries about higher tech debt, outlook for productivity gains, or monetization potential just too long term to matter for the near term. Max joins us right now to talk a little bit more about that. And Max, we talk about investor sentiment. Investor sentiment had gotten a big boost over the past few months because of the sustainability of that AI trade. We saw a bit of a rethink, though, of that over the last 4 weeks. Is that a rethink or the end of it?
No, I don't think it's the end of it at all. Actually, when we look at the last couple of weeks, the biggest shift I think that we've seen and the biggest change was really an investor sentiment. Whereas I would say August, September, and in large parts of October as well, in lots of our client conversations, at least lots of clients were saying, look, we're waiting for the dip, we're ready to buy the dip. That's completely changed in the last 4.5 weeks over November, where really most investors have been saying, no, this might actually be the end of it. This is threatening the overall OpenAI universe. It might only really benefit Google. So is that the end of the entire NVIDIA trade, the entire hyperscaler trade? And the biggest shift really was in the last 4.5 weeks in terms of our positioning indicators. When we look at that, even systematic positioning, so the likes of CTAs, but particularly risk parity and volatility target strategies, momentum signals, that were flashing some sort of warning signal in August and September. On our measures, that was above the 95th percentile. Even that has come off to the 50th percentile. Right. So even within already light positioning, the one warning sign we had, that has all but disappeared in November.
And so the catalyst to really recover, Max, is that the December Fed decision?
I don't think so. I don't think it's just the December Fed decision, because let's be honest, for risk assets overall, I don't think it matters greatly if the Fed says in December, look, we're not going to cut, but we are wary of what was been the beige book this week. We are wary that labor market conditions are tightening. So if they then say there may be near-term cuts, i.e. a January cut, I don't think, equities, credit spreads, the dollar, EM assets, I don't think they will greatly care whether a rate cut comes in December or January. Likewise, if it happens then in December and they say, well, but don't confuse that for an overall rate cut cycle all the way down below neutral, like the front end is pricing right now. Again, if they say that in December instead of January, that's not going to move the needle an awful lot. I think what matters much, much more in terms of the catalyst for not only the next month, but really the next 2-3 months is once again earnings. When we look at the earnings expectations,
we've only just had them.
We've
only just had NVIDIA earnings, and that gave us no resiliency, even though they beat and they guided to the better expectations of the entire market.
Yeah, Caroline, we could argue that, but we could also argue that's been basically what's been overshadowing the earnings from NVIDIA was the concerns around OpenAI. And we can also say that when we look at investor positioning, if you've got the mix of, once again, more subdued investor positioning, but on the other hand, overall an earnings season that has once again been much, much stronger. Let's remember that the earnings beat rate for the third quarter has once again been the best one since COVID, since 2021. And now we're facing a setup for the fourth quarter earnings season starting in January, where once again consensus has actually in the last couple of weeks been downgrading expectations. Bear in mind, consensus now says quarter over quarter sequential earnings growth for the S&P from the fourth to the third quarter is down 1%. If you exclude tech, we're talking about net income expectations, bottom-up expectations for the S&P of -8%. -8%. 8 of the 11 sectors are expected to report a sequential decline in earnings. That is such an uber bearish setup that I do fear that once again people have been cutting perhaps or taking up hedges in November too much, and they're not going long risk enough in what I think could be a proper melt up in the next 2-3 months. Earnings driven once again.
Well, with regards to that earnings driven though, Max, strip out some of the tech stuff and all that big cap stuff. We actually saw a relatively strong earnings season for a lot of the small and mid caps, at least here in the United States. And there has been some optimism that if we do see those names have some sustainability in some of those earnings reports for the fourth quarter and beyond, that actually might be a much, I guess, stronger bit of fuel for this market than just the big cap tech stocks.
Yeah, I do think that is true. And in fact, when we look at even the year-to-date performance, I keep getting asked, look, when is the broadening finally happening? And I do think sometimes people define broadening a little bit wrong. In my mind, it's a bit like, well, do I buy tech or do I buy the other stuff? And for me, broadening is, well, I'm still buying tech because I do think the CapEx incentives in the big, beautiful bill are really positive for AI CapEx. But I'm also buying some of the other stuff. And that has happened really year to date as well. Look at industrials, look at healthcare, look at financials, even energy, despite the lower oil prices. All of those are up sort of 6 to 14% year to date. So the broadening really has been happening, not only in earnings, but already also in performance.
Max, always great to catch up with you. Max Kettner over at HSBC.